strategies that can mitigate and manage volatility. There's more than one, and they work differently, and they're not the bull market strategy. So a growth strategy is a bull market strategy. You don't want a growth strategy. The types of strategies that can maintain and work for you in this environment, although nothing works perfectly all the time, but over a period of time, whether it's a month or 6 months or a year or two, even in a bear market, things can work. Having what's called value momentum stocks can work in a bear market. You want high quality stocks in the sectors that do well based on the market phase that you're in. So for example, this is not the stock market, this is the economy, late phase. Remember, that's where the US is kind of transitioning right here between late phase and recession. Things like real estate and consumer staples and healthcare and utilities tend to do well late cycle. And in some of those, a lot of those strategies can carry over to the recessionary phase, like utilities, consumer staples, healthcare tends to work well as well, consumer discretion. So here are some examples, things like Cummins and Chevron, Energy and Dumont. Whereas recessionary names, you'll see a lot of food in that category. People need to eat, they need to economize. And so those type of sectors tend to do very well in late phase of recession. So if you're going to own companies, we tend to want to overweight to these companies. And then when you get through the recession, that's where the technology comes back in. When interest rates are coming down and earnings are growing and everything is going back to normal and good, technology can do really, really well. And I'm not saying that you shouldn't own companies that are out of favor through business cycles that you don't like. You just tend to want to be focused on companies that work well in the business cycle that you're in. And so value momentum stocks, that's what that's all about, finding companies that are inexpensive, that are in the right sector. Okay. Another one is alternatives. Alternatives is basically not stocks, not bonds. There are two types of alternatives, big picture. You have public alternatives and you have private alternatives. Private investments, I break out as its own. And there's three types. You have real estate, private equity, and private capital, which is debt, private debt, and private stocks, basically, and private real estate. The advantage to private is you don't get the same kind of run-ups in a late phase bull market, and therefore you tend not to get the same type of down runs. You tend to get more consistency over time with much less volatility. And the trade-off is you've got to give up liquidity. You can't get your money whenever you want. You have to wait sometimes 3 months, sometimes longer to be able to get money out of it. It's investing directly in a business. A great example is maybe SpaceX versus Tesla. Both have a CEO that's a little crazy. Tesla's stock price is really nuts, whereas if you look at SpaceX, it's basically every quarter as the business grows, they just get an increased valuation. So, but there's a lot less liquidity. So it's not like one's better, one's worse, but it is important to have private in a portfolio because more and more and more companies are not public. If you look today, of all the companies generating $15 million in revenue or more, only 2% of them are public. 98% of them are private. So just to be diversified, you have to have private in a portfolio. And there's multiple ways to do that, which we can get into at another time. But it's an important asset class to have. Then there's public alternatives, which use hedging strategies. So like hedge funds, which make people nervous, but some hedge funds are really mitigating risk and some are taking on extra risk. I like the type that can mitigate risk and to create more consistency. There's arbitrage funds, you're investing in companies being acquired. Again, very consistent returns, no home runs. They tend to underperform in a bull market, but they tend to perform consistently in bull or bear markets. And that's especially important in a bear market is consistency. So that's really an important asset class in bear markets. Bond portfolio, you really got to own individual bonds and a rising short-term individual bonds is told them to maturity. Otherwise, you'll get hurt either through bankruptcies or through rising interest rates. It's very, very volatile. But by owning 3 months, 6 month, 1 year bonds, especially if they're high quality corporate or even better government, as long as you hold to maturity, it's guaranteed. And if you need to cash it in sooner, there's no penalties or anything. And if they're short term, you're probably not going to lose much, if any, money. So that's a very important category. And it's important that you do it right in a bear market. Having an income portfolio if you're retired, having strategies that can generate a lot of income. Private is one of those strategies that can generate a lot of income. Real estate generates about 8% a year. Private equity about 3.5%. There are other strategies using stock options and credit where it's incredible the level of income that's being generated right now. It's not unusual to see over 10% dividends. It's a really wonderful strategy if you're retired, especially in a bear market. Again, in a bear market, you just don't want, you want to kind of avoid growth, your Teslas and Apples of the world, unless you're taking a very long time frame. Long short, the ability to go up when the market goes up is long. Short, it gives you the ability to go up when the market's going down. Another term for it is inverse fund. It just does the inverse of whatever the market is doing overall. So the bottom line on this is, figuring out the allocation of these, what you're comfortable with, what your risk tolerance is, and then blending them to give you true diversification. Each category is diversified, and then you're diversifying categories. And each of these categories can do well throughout a bear market cycle, which is always the goal of investing. Why be invested if you're just going to lose money? So it's hard to do that over any time frame. And it's hard to get up to speed on all these different strategies, but they are important strategies to learn about. And if you're a client, we've talked to you about all of these. And if you're not a client, we're happy to talk to you about them. Again, that's where we're at. Those are the different companies for the different cycles that are interesting. So that pretty much wraps it up. So as always, we're looking for feedback and any thoughts that you have, anything that we can be helpful, don't hesitate to let us know. Thanks so much.